It is a great pleasure to welcome to Best Ideas 2024 returning MOI Global instructor Frank Fischer, the CEO of Shareholder Value Management AG, where he also serves as Chief Investment Officer. Frank is also a board member of Shareholder Value Beteiligungen AG. Until the end of 2005, he was managing director of Standard & Poor's Fund Services and was responsible for investment fund information and ratings. After completing his training as a banker at the Hessische Landesbank, Frank studied economics at the Goethe University of Frankfurt, where he finished with his degree in business administration. He's married and has 2 children. He and his wife are the founders and directors of the nonprofit foundation Stiftung Starke Lunge. Frank, always such a great pleasure to have you with us. Your presentations are of great value to the MOI Global community, and I am grateful to you for taking the time to be here today and share another idea with our members. And with that, I'd like to turn it to you. Please go ahead.
Thanks for having me again. Yeah, and I'm quite excited to show you an idea which I think is a great opportunity to look at the sector biotech, which we really are not that deeply into looking at the gold diggers themselves because we don't know enough about them. But when you actually look at that industry and the dynamics, it's highly appealing. And so we approach it with a view to provide shovels and more for those gold seekers, having a much more risk-averse approach towards investing in that sector. And that's in the past always been a very, very good way for us to make decent returns, not looking at this one-hit wonder when you really try to find that gold digger that's hitting this incredible claim, but actually you deliver those goods which they all need, and you'll do well. And that's exactly my idea with Sartorius Stedem Biotech. Now, when you look at what that business is doing, you always wonder, what's the guy telling me? Has he actually delivered last year? Well, I think we have. This was last year's best idea. It's the German SAP with Sartorius Stedem Biotech. This is a French company, even though the majority owner is a German DAX company. It is a French one. And here we have another DAX company, an SAP, which we liked and still do. We consider Oracle to be superior, especially regarding capital allocation. The ownership aspect of Oracle is actually generating even better returns, we think. But when you look at the undervaluation of SAP at the time when we presented that idea, was actually a really good idea to go and have a look at it. And if you want to revisit the idea and hope for the reset for your re-entry, maybe, here's the link to Manual of Ideas, which you can click on here on the right-hand side. And so you can review that idea if you care. So what are we doing, really? We are value investors, and I label the way that we go about value investing modern value, which means we have a bias towards wonderful companies and not so much towards the Benjamin Graham type low PE, low price book value. We look at the wonderful companies because we agree with Warren and, of course, Charlie, that it's much better to pay a reasonable price, a fair price for a wonderful company than paying just a wonderful price for a fair company. And there is a reason why that is better for us. Those are the aspects of wonderful companies that appeal to us. We like the growth in their industries, and we like growth which is bigger, ideally twice as much as GDP. And they tend to obtain better returns on their assets than the competitors. And of course, they exploit opportunities when they arise, also in M&A. So we like serial acquirers as well. Sometimes they are more active, sometimes that is just an add-on to the organic growth. And of course, this innovation element and the continuous improvement process in these businesses, because they have managed to be an attractive employer and they've established a culture which is appealing to talent, that is really very, very good because that helps you continue to build your moat and make sure that also if there are adverse effects, and such an adverse effect actually hit Sartorius Steele Biotech, you have the capacity to suffer. And because of that, you'll continue to be in business after a crisis is actually calming down. Now, also, they are really good stewards of capital. They know that they can reinvest and probably even at even higher returns the cash flow that they generate. That's the key aspects for us for wonderful businesses. And of course, when you look at this element of time, this compounding element, clearly, if you only have 5 or 6% return on equity, when you have a great margin of safety, it won't do you well over a long time. But if you have something that gives you 20 or 25% return on equity over time, and you have that for a long while, well, that's the wonderful miracle of compounding that works for you, that works in your favor. And this is another aspect, actually knowing that Warren made a lot of his money just by sitting on his ass, as he said, is basically something you learn, you understand the business better, and then you know when it's time to add or reallocate some fresh cash to that business if it is actually trading with a margin of safety. So these elements with these quality companies, the growth dynamics already said above 20% return on capital. And what we really love is when you actually have the opportunity to redeploy your cash and get incrementally better returns. And of course, we look at those structural competitive advantages at the moat and whether that's feasible and makes sense that this business will still be around within the next 10 years and even do better, potentially. Of course, future is always uncertain, but if we get comfortable with the fact that these guys are actually in such a good shape that we can see that they'll do well and that they're in the markets which are attractive, we love that. Still, we think that moderate debt levels for most businesses are really what we're looking for because there's always the risk that if you have too much debt, that the bank basically is in control and actually dictates you what should happen. Now, also an element that we like is if there is reduced principal agent conflicts. That is the case, especially in family or manager-owned companies or in businesses which actually don't have such incredible share-based compensation that the free cash flow is completely consumed by management and not much is left for you as a shareholder. So to sum it up, culture is important. It can act as a talent magnet and it can ensure constant innovation. And since markets and technologies are moving so quickly, that tends to be overlooked element in the whole investment thesis. Now, once you have all that, you can easily get carried away, but you must not forget that a margin of safety is really what's required. So don't overpay for such a wonderful business is still really critical. We're after all value investors, even though we're going for this modern value style, it is the same truth, which is you can't just go in there. Otherwise, you're a growth investor. If you're kind of agnostic to the valuation, you think you're going to be healed anyway because of that growth and the great returns. Well, sometimes you get it wrong. And so we always believe that it's much better to be careful and require a margin of safety and then go at it when the opportunity presents itself to you. Now, why is there such an opportunity? That's what I'll share with you. This is our top pick. We think that Sartorius Steele Biotech is one of these wonderful businesses. The key aspect for that business is their single-use container technology, and also the associated consumables when you actually go into biotech drug manufacturing. When you think about what they're doing, you could say these are kind of these bioreactors, they're glorified plastic bags. Of course, they can be quite sizable, but they don't have to be. An mRNA is not really a huge of huge size, so you can actually, even in small sizes, have, as we learned with the vaccines, very, very potent drugs. And in order to produce those with little waste and actually high yield, you need a lot of competence amongst engineering and biologists and chemists, and you need just a lot of competence from many different areas. And this is what they've pulled together, and this is why they are the go-to place for the big pharmaceuticals or also the emerging biotech companies with great ideas. Now, historically, they have actually done extremely well. When you look at 28% TSR over the past decade, this is something which is quite unusual, especially in Europe. So they also were helped by the COVID boom, and that COVID boom was basically completely going against them because it led to an overstocking and now a destocking, and thus we think the underlying secular growth trend is still intact, but it has been kind of overhyped, and now kind of really in a very depressed way, it's undershot. And so we think that these transitory effects, they are coming to an end. There's a likelihood that it is very close to coming to an end, because on Jan 26th, there could be a clearing event when the fiscal year results will be presented, fiscal year results 23, and guidance for the next years will be given. That is maybe already the clearing event. But if it is another quarter or two, then so be it. We are investors and not speculators, so I don't know whether it is the clearing event, but it could be. And so in order for you not to miss it, it's probably best to really start quickly with understanding that business. So we are in a very resilient business model with secure growth. Now, why is that so? Those products are really mission critical in the biomanufacturing process. You have basically living cells, whether you are looking at adenovirus, you have so many different cells which you can now use to manufacture and the drugs that are required to embrace this biopharmaceutical revolution, which is already happening, but which we believe will drive even further growth. I think this is something where you really need a place where you feel safe, because you invest as a big pharmaceutical company a lot of money and effort, and you want to make sure that you really have a one-stop shop that can do it all for you, which has been the trusted party for many years in the past, where they've got the talent, and if someone leaves, that they are a company which can attract a new person that will fill that gap, and that you don't risk your entire process. So 75% of the revenues are recurring consumables, which are used during the production. And since it is an FDA-approved drug process, it cannot be easily replaced. We love that bit very much, because once the FDA approval is there, then it doesn't make that much sense to switch for, if you wish, mission critical C components elements, even though you might pay up, because they will then charge you for those consumables a price that is reflective of all the effort that went into getting the process right in the first place. And so the pharma industry, the big guys, they account for 95% of revenue. So you're not really relying so much on the new smallish biotech companies, the venture capital aspect is an element, clearly, but really the big pharma players are the key clients, and that market is expected to grow at roughly 10% in 22 to 26. Now, when you look at an idea of the product portfolio, filtration is at the core. When you look at the DNA of Sartorius, the parent company, they started out in the 19th century with filtration. And then, of course, purification, fermentation, fluid management, all the aspects required to get the product right to actually end up with the pharmaceutical drug that's required to heal all these diseases, and probably a lot will also happen in oncology in the future. And at the core of it are all these products that you're seeing here. They have roughly 50% market share in the single-use containers globally. So Stedem is really the dominant player. It is thus an oligopoly with high barriers to entry. We love the moat aspect. And one key aspect is it's not a pill, but usually those drugs are administered intravenously. So it requires to comply with the highest regulatory standards. And that is something where you just don't take those risks by going somewhere else if you have a trusted partner. It's very unlikely that you go outside of those few players which provide you those services and products. So that is why the market is quite concentrated. Now, from Sartorius, this is the way they see themselves. We've looked at other consultants, and you see that you've got Merck, you've got Danaher and Thermo Fisher, and they have various parts of the offering is what they also bring to the table. But the most comprehensive offering currently is sitting with Sartorius. And we love that aspect because they will definitely benefit from those wonderful dynamics in this industry. Now, the share price, as I mentioned before, was driven by very strong fundamentals, both on the sales CAGR side and also on the increase of the EBITDA margin. Historically, that was just wonderful. Of course, the COVID boom then drove everything up even higher. Now, after that boom, there was also then a bit of a bust. And this is why the share price has also taken a bit of a beating. Here you see it against the MSCI World since 2010. And you can see that it's outperformed dramatically, but it now has been really hit and has taken a bit of a beating here. And that is what we think is the opportunity. Why did it take that beating? It's the destocking after the boom in the super cycle. So during COVID, there was an incredible increase in the demand by the vaccine industry. You remember we all had to get those shots in order to still have a life. And of course, that meant that you had to just stock up. There were also issues on the supply chain. And so the customers tended to overstock, basically, to be sure to participate in the boom and deliver, and also make sure that they can live up to what was expected from them by the governments. So those sales increases in 20 and 21, we don't expect that to be something that we can expect in the future, but that was priced out. And of course, it led to the share price also overshooting dramatically. Now, we have this hangover effect since the pandemic has faded away, at least the perception of the risk associated with it. It's now more part of normal life. And clearly that means that the supply chains, those issues have actually gone away mostly. Then we've had a rise in interest rates. So suddenly, when you put your stuff in your warehouse, well, you could actually take that money and put it in the bank account and get some interest rates. And so the customers actually reduced orders and brought them down even to the levels which were lower than they were, let's say, in 2019 or 18 on a comparable basis. So this is why the sales are expected to decline by 19% in 2023. So it's really this hangover effect, and you don't see that this industry is really growing very nicely because we've had the boom and now the bust. Now, when you look at the performance versus the peers, when you look at Fischer or Danaher and Merck, you see Stedem has really outperformed before, but now has taken the biggest part of the beating. And it is the only pure play among those four leading players because all the others have their conglomerates. They are, especially Thermo Fisher and Danaher, serial acquiring machines. And yeah, you have some acquisition element with Stedem as well. They acquired for a huge amount of money PolyPlus technology, which they consider being absolutely vital to benefit from those growth trends in the future. But it also yanked up their leverage. And so we are now at 4.5 times net debt to EBITDA in a rising interest rate environment. And that was not very welcome by the market because, of course, when you combine the increased leverage and higher interest rate with the fact that you're now taking 19% probably beating on your revenue and thus, of course, also on your earnings, then it becomes more risky. So there were reasons why it wasn't everybody's darling anymore. So what is our thesis? Why is it now a good idea to look at it? We think that the inventory expiry will lead to a restocking. And this is really at the core of our thesis. So when you buy your stock during COVID-19 and you look at your expiration dates, well, then clearly you have to see, well, it's over. You can't use it anymore. And so we've seen this during 2017 and 18 in the inventory cycle. The destocking headwinds turned into restocking tailwinds. We think that this is very likely that a similar snapback in order is going to happen, and we think this could already start in 2024. Question is this Q1 or Q3? Well, actually, for us as long-term investors, it's not that relevant because we know this is already a very juicy return that we're getting currently. So when you look at others that actually made calls and also Stedem's own assessment of the current situation, you can see also during the virtual capital market day that there seems to be the first elements of positive trend change. Also from Repligen, a small US peer to Sartorius, they said September, October, they had strong order intakes. Now the question is that already sustainable or will we see another destocking effect in a quarter? But when you really think through the industry trends, then you should maybe consider, if that's the fact, buying in 2 stages if you want to own a position here, because ultimately those underlying industry trends will lead to decent growth in that business. The channel checks that we've done ourselves in the bioprocessing industry, they support that there is improving sentiment. So we're quite comfortable with the call that during 24, we'll go back to the growth elements which are in that industry. What are they? The underlying market trends, they are really, really healthy. When you look at long-term average of 15%, then that's really nice. The pharma market is okay. The biopharma market is already really nice. Biosimilars is much better. And then you look at the next generation cell and gene therapies, and they are actually expected to grow at around 20%. So this is you really need single-use containers here, and that's really at the core. So we think that the growth, double-digit growth, will continue, and that we can participate after that destocking is over by being patient and owning a position and holding it for the long term, because here are pillars of growth which we think are here to stay, and thus it gives us a level of comfort also with a market structure that we are very happy owners of that business. Now, the balance sheet reflects the acquisition. Um, there is significant deleveraging projected, so they kind of had their shot, and they can't. Maybe they have a smallish acquisitions they can still do, but nothing major, because you can see the effect it has had on the equity ratio. Net debt was dramatically increased, and they want to bring that down before they can have the next go at maybe technology, which will then further their growth. But at this stage, there will be very little happening. If you wish, the damage has already happened. They've spent their money. Now they need to reduce it with all the cash that they generate. This is the good news. It's a very stable cash generator. And after that, destocking will go back to then having a much more healthy balance sheet. And then we'll look at to what the next aspects will be that they require to benefit with those growth elements. So the recovery from now onwards, we think the new midterm guidance, which will be presented, they already announced that with the 23 results, it could be a 5-year horizon. And we think it will underpin our assessment. This should be double-digit sales growth and also going back to historic profitability. Now, maybe they'll be a bit more modest and then leave room for further upgrades, but there is a nice 500 basis points plus EBITDA margin recovery potential. And based on our valuation, when we look at historic trends, we believe that we are already at low to mid-teen total shareholder returns for the stock over a 5-year time frame on a going concern basis as is today. So there is, however, we're relatively modest on our exit multiple, a potential takeover scenario, which at the end of that 5-year time frame could lead to an effect where there is a catalyst in a takeover where you get an even higher multiple, and this would mean that we'll get mid to high teens TSR, and that's something which we like as a free optionality on top, because the structure that we basically look at currently is such that there will be the executor which does the administration is basically of the last will of the founder. This is coming to an end in mid 28, and so there could be an acquisition looming at that point because the heirs might actually decide that they want the cash. So this is an additional element which we like. Now the question is, there's also Sartorius. Why would you go for Stedem? We really like that pure play in this really nice bioprocessing market. It actually also has higher capital returns. And Sartorius Lab division, where you have the filters, this is the history where Sartorius is coming from. It also depends a bit on public and private R&D budgets. And so it's not directly only linked to the bioprocessing market. It is tied to it, but we love the pure play aspect of Stedem. And the leverage is a little lower, 4.5 times for Stedem versus 5 times for Sartorius. And the valuation currently is more attractive. There's a 15% discount to Sartorius on a PE basis. Now, that is because of Sartorius is more, the preference shares are more liquid. Yeah, there's less free float in Stedem because Sartorius is the major owner. So there are reasons for that, but we love that aspect, and we're not that big, so we can still have enough liquidity in the stock. So we embrace that idea via Stedem. In case there would be a takeover for Sartorius, it would trigger a mandatory bid for Stedem due to the change of control. And that's basically what the investor relations lady said, and it makes perfect sense. Now, just to show you what we're doing, and this is not just a one-hit wonder, we look at that and we also have it in our mandates. We have an ETF, and you might want to have a look at other ideas if you like the presentation that I've just given you. We have 25 wonderful businesses identified. where we see they have ranked in order the highest total shareholder return for the next 5 years. And we have a quarterly rebalancing for those ideas, and they'll all be reset to 4%, as we did at the end of last year. We're always 100% invested, fully invested, clearly. And since it's based on an index, everything is transparent. You can see the underlyings, etc. But so you don't have to go to Bloomberg. You'll see it here as well. This is the composition as of the 12th of Jan. And Sartorius Stedim Biotech has the 4.47% allocation currently in our ETF, the Frankfurt's UCITS ETF Modern Value, which is based on our Modern Value Index. This is what we've achieved last year. So we were at 30 plus, which we think is really nice for our index compared to the MSCI World Net Total Return. It's a decent outperformance with our quality concept in going into wonderful businesses. And when you look at the long-term track record of that index, the ETF was only investable as of July. The performance of the ETF is 32% since then, and it actually generated, the index did 15% per annum. And so we think that is reflective of the returns which are achievable with such a wonderful business strategy. And we think that we can look forward to doing that for the long term. Now, this is our family of funds, where you basically can choose between the Modern Value Equity, the ETF, or dynamic balance funds, depending on the risk aspect of investors. And the idea for us is to have long-term wealth creation with lower volatility compared to stock market, and at full investment with higher returns. We do have that preference for great cultures or owner or family managed wonderful businesses. We look at ESG aspects because we don't think that it's sustainable not to look at those aspects. And we see a lot of investors now embracing those criteria and also monitoring that we actually do what we say. And that's exactly what we enjoy doing. We have a long-standing expertise. I've been investing now for a good 40 years already. And we are also an owner-managed fund advisor. These are my colleagues. If you have further questions, I'm happy to reach out to myself or my colleagues. And of course, we actually own the position. I showed you that we have the position in the ETF. And so we're talking our own book, if you wish, and there are risks clearly associated with it. But if you liked it, most of the stuff, unfortunately, will be in German, but you'll find us in many areas, and I think Google Translate will help a great deal. So you might want to go to our YouTube channel and look at the transcripts, or the other social media. I can just invite you to have a look at what we're doing also in our blog. Since it is risky, here's the legal disclaimer, but I know you're all investors and you know that there are risks associated with it. I don't have a crystal ball in front of me, but I think our idea, Sartorius Stedim Biotech, the shovel and more for this biopharma gold rush could be a really good way to participate in the underlying growth in that market. And I hope it will work out that way for you, and that I've presented you an idea which is worth embracing. So thank you very much for your attention.
Wonderful, Frank. Thank you so much for the presentation and this very interesting idea. Perhaps we could start with the risks to the thesis. How do you think about sort of the key long-term risk here?
Well, clearly the key long-term risks are such that there could be new technologies, some of which we might not even be aware of. So innovation is a risk. So if there are new ways to produce those drugs, which might not be within the IP that's accessible to Sartorius Stedim Biotech, then that is a risk that we might be we have to monitor that. We already do. At this stage, we can't see anything, but it's something that you clearly have to monitor, because this is, of course, the beauty for us as consumers and beneficiaries of all the innovation. The returns which are there in that industry are so appealing that there will be lots of people trying to find new ways. And sometimes it leads, as we've just seen, to Sartorius having to actually acquire a technology because they see this as so essential to participate in the future in that market, that they then have to really dig deep into their wallets and pay up for it. So that's one way to mitigate those risks, as they've just done by paying up for technology which they didn't own. So there are answers to dealing with those risks, but those are one of the main risks that we see. And of course, it could also be a risk that the entire customer base, because of all the countries, they are quite heavily indebted, and the healthcare systems are very much burdened. And so maybe the customers won't be doing as well anymore and can't pay as much. Now, that's something which we also need to monitor, that for innovation, you still get paid the innovation premium for the patents that you are then able to file. But that is also a risk that the funding kind of dries up in your customer base. And because they're hurting, they can't make the same money anymore. And that is an issue that is still something that you need to monitor.
And in terms of capital allocation going forward, seems pretty clearly focused on debt reduction. What kind of debt to EBITDA you think is a comfortable level for the company? And do you have any sense for when that level might be reached, and then kind of broaden the scope of the capital allocation options?
Well, with a quality business, usually, especially with that free cash flow generation, there's no reason to be concerned when you go to the 2 to 2.5 times net debt to EBITDA level. But I would expect these guys to still be acquisitive, and so we wouldn't be surprised if they will be investing again, and that they will actually also look at leveraging up their balance sheet once they've reduced the level of debt. If there is new technology which is worth their while, we expect them to do that. But because they are just so cash generative, we think that within usually 2 years after they've made those acquisitions, they will bring down the level of debt to something which is more manageable, and they can then they will be tempted to lever up again if they see something coming up which is not coming from their own innovation efforts. Historically, that has happened before, and we would not be surprised if that happens again. But sometimes these are just small acquisitions with great technology, because they're just early enough to be moving at a better time, opportunistic time, where the full value hasn't been realized. Mind you, Sartorius acquired Stedin. That's like 2 decades ago, kind of. So at that stage, it was a bet which paid out extremely well for Sartorius. But when you actually have such clever guys that manage to understand those trends and the opportunity in those sectors, then that can be good for long run rates of generating free cash flow. So I'd expect that M&A at the core of what they're doing will remain, and that we should see that as a positive element and not as something to worry about, because the cash flow they're generating reduces the level of debt within reasonable time to something which is more bearable.
Could you elaborate on the management team here and your confidence in their ability to execute?
Yes, well, the management team is something where there is a bit of a concern because the Sartorius CEO most likely is going to be going into rent and retiring. And so we don't know the successor. So that's something which we need to monitor because the guy was really great at giving you the clarity and the level of detail in the communication with the investors that you would require. And for a long while, he always got it right. He didn't really get the destocking right. He was surprised, and many people were kind of shocked because he was so reliable in his guidance. That also led to quite a level of uncomfort, if you wish, and a distrust in the talent. But I think the destocking was very hard to tell. Many others in the industry got that wrong. But this good guy that has done so well for the business, unfortunately, will be replaced, and we have to monitor and see that. Not that there is not enough other talent around, but when you look at also M&A decisions, the guy at the top clearly plays a big role in getting that right, and that is also a risk that will happen, and it's foreseeable. Everyone knows that unfortunately the CEO will leave, and we need to see that the new guy will be equally as good or better in order to be long-term holders.
Okay, wonderful. Well, I will leave it there. Frank would just encourage MOI Global members to feel free to follow up with any further thoughts or questions. You provided some contacts there on the last slide. We're also always happy to facilitate an introduction. Once again, thank you so much for joining us and sharing your perspective today.
Thank you.
Goodbye for now.
Bye.